Okay, let's unpack this. You've probably seen the headlines, right? A company positioned as a real leader in cutting-edge tech, stuff powering our future EVs, clean energy.
Yeah, the big growth areas.
Exactly. And suddenly, they're facing reports of, well, imminent bankruptcy. How does a pioneer in a market that's supposed to be booming end up here?
It's a sharp turnaround, definitely.
Welcome to a deep dive into Wolfspeed, ticker symbol WOLF. They're the silicon carbide and gallium nitride technology company right at the center of this whole storm.
Yeah, second GaN. Important stuff.
So our mission today, and thanks to a listener who shared a whole stack of sources with us, is basically to go through this material with you. We want to highlight the really important insights and, help you understand the complex situation facing Wolfspeed.
We'll be looking at everything, the tech, the financials, the market pressures. It's quite a story.
It really is. It's a fascinating, though concerning case study, isn't it? How quickly things can change in tech, even in these high-growth sectors.
Absolutely. And understanding companies like this, peeling back the layers based on the available info, well, that's exactly what we try to do here.
And hey, just a quick mention, if you're a member of Stock Analytics AI, it's just $4.99 a month yours. You can actually give us a ticker, like WOLF, and get your deep dive prioritized.
Yeah, it's a good way to get analysis focused on the companies you're following closely.
We're pulling everything today directly from the source material our listener provided. You can find links to that right down in the description.
All based on those sources.
And definitely stick around, because towards the end, we're going to leave you with a potent final thought, something about the true, maybe devastating cost of execution failures, even when you've got groundbreaking tech.
It's a key takeaway from this situation, for sure.
So let's start at the beginning then. What exactly is Wolfspeed? What do they do? How do they make money?
Okay, so based on the sources, Wolfspeed positions itself as like a pure play leader in silicon carbide, that's ECC and gallium nitride, GaN technologies. Their core business is designing, manufacturing, and selling these advanced semiconductor materials and components.
Right. So on the material side, that means things like CC substrates and epitaxy, like the foundational layers the wafer's chips are built on.
Exactly. Think of it as the raw, high-tech material. And then on the device side, they make the actual components, things like CC power modules, MOSFETs, diodes, the bits that actually manage the power efficiently.
Critical pieces for high-demand applications, though.
Absolutely critical. And who buys this stuff?
Yeah.
Well, the sources say their main customers are in these really high-growth sectors, places demanding better power efficiency. So electric vehicles, both the cars themselves, the powertrain, and the fast charging station.
Okay, makes sense.
Renewable energy systems, solar, wind energy storage, and then various industrial uses, power supplies, data centers, that kind of thing.
So selling materials and devices, that's the main game. But the sources mentioned some smaller income streams too, licensing, custom contracts.
Yeah, they do have some other income. Tech licensing brought in, $12.5 million in fiscal 23. Custom contracts around $37 million. Services about $18 million. So, tens of millions. But it's clear the materials and devices are the core drivers. Not insignificant, but not the main engine.
Got it. And what about recent numbers? How's the revenue looking?
Well, looking at the recent figures from the sources, Q3 of their fiscal year 2025, total revenue was $185.4 million.
Good.
And that split was about $107.5 million from power products, so the components, and $77.9 million from materials. Now, that was a small bump up from the previous quarter.
Sequentially, yeah.
Sequentially, yes. But it was actually down 7.6% compared to the same quarter last year over year.
Down year over year. That's interesting, especially given the pivot they're trying to make, right?
Yeah.
The sources highlight this strategic shift.
Exactly. Wolfspeed has historically been, a real powerhouse in the CC materials market, but they've been pouring money into becoming a major manufacturer of the devices built on those materials.
Right, the finished components.
Yeah. And that means massive capital investments, what we call CapEx, building these huge, really cutting-edge factories, particularly their new 200-millimeter wafer fab. We're talking huge sums of money tied up in buildings and equipment.
And these investments are so big, the sources say they're really leaning on outside funding, government incentives and things like that.
Heavily. The sources note they're anticipating possibly $1 billion in cash tax refunds under Section 48D. And they're actively pursuing up to $750 million through the CHES Act.
Wow. Big numbers.
Huge numbers. And these funds are specifically earmarked, the sources say, to support that CapEx and, frankly, shore up their financial structure.
Okay, now here's where it gets worrying, based on what I read. That materials business, their historical strength, it's actually declining.
It is. That's a key point in the sources. Materials revenue was down significantly 21% year over year in that Q3 FY25.
21%. That feels like incredibly bad timing. They're in the middle of this massive spending spree on new factories, and the part of the business that used to generate cash is shrinking fast.
It's a major headwind. The sources suggest this decline is probably due to, well, intense competition possibly, from lower-cost Chinese substrate makers flooding the market, and maybe a bit of a slowdown in the overall market demand.
So that creates this kind of squeeze, as the sources put it.
Exactly. The materials money is drying up before their big bet on 200-millimeter device manufacturing can really ramp up and start paying off. This just hammers their cash flow and makes them even more dependent on getting that external funding and managing their debt.
And that dependency on government funding, that's got its own set of risks, right?
Oh, absolutely. The sources are clear on this. There's uncertainty about the timing, when, or even if they'll get the full amounts. Some of that Shite PS Act money might even be conditional on them successfully restructuring their huge pile of debt.
Debt restructuring. Okay.
And then there's the political angle. There's been talk, apparently, about potentially repealing the Shite PS Act. So nothing's guaranteed.
So given how much cash they're burning through, I mean, spending way more than they make, any delay or cut in that funding would be bad.
It would be a severe blow. It puts their big CapEx plans at risk, maybe even their ability to keep operating in the near term. Their future really seems to hang on getting that external help.
What about gallium nitride? They do that too, but the focus is CP.
Yeah, they work with GaN materials, mostly for RF, radio frequency stuff, and some specialized power applications. The sources do mention a pretty significant growth forecast for the U.S. GaN market specifically.
But Wolfspeed's focus is CT.
Overwhelmingly C-tests, according to the sources. Their strategy, their capital, it's all directed there. And this is flagged as a potential concentration risk. While CT is obviously huge, they might be missing out on growth in GaN by not investing enough there.
Okay, so market position. Historically, they were pioneers, right? Leaders.
Definitely. The sources paint them as pioneers. They led early SiC adoption. They were the first big player pushing into 200-millimeter wafers, which is the next generation size. Reportedly, the #4 player in power SiC devices back in 2024.
And that big Mohawk Valley 200-millimeter fab was supposed to cement that leadership.
That was the plan. World's first and largest 200-millimeter SiC fab, a cornerstone of their strategy.
That leadership is now, what, under severe threat?
Under severe threat is putting it mildly. The sources highlight a really dramatic fall in their wafer market share. Estimates went from maybe 32% down to 19%.
Wow.
And the most striking figure, the one that tells the story, their market cap, the total stock value, it collapsed from $4.2 billion in January 2024 to around $266 million in May 2025.
Billion with a B down to million. That's catastrophic.
It is, and reports of potential bankruptcy are now widespread. It just screams of this massive disconnect, doesn't it, between the acknowledged tech leadership, the huge investment, and the absolute failure on the financial and operational execution side. Investors have clearly lost all confidence. Those huge, expensive factories they built, right now they're just a massive financial burden because they're underutilized and costing too much to run.
Why aren't they utilized efficiently? What's the core problem there?
The sources point squarely at major operational inefficiencies, specifically really low manufacturing yields at that critical new 200-millimeter Mohawk Valley fab.
Yields. Okay, explain that for listeners maybe not deep in semiconductor manufacturing. What does a low yield mean in practice?
Okay, think of it like baking cookies. Your recipe says you should get, say, 100 cookies from your batch of dough. But if you only end up with 30 good ones and the rest are burnt or broken,
you've wasted a lot of dough and energy.
Exactly. You've wasted expensive ingredients, time, oven energy. Low yields in chip making mean for every costly sissy wafer you put through the process, only a small fraction of the potential chips on it are actually good and usable. It just skyrockets your cost for each good chip you produce.
So their big, pioneering 200-millimeter factory, which should be a massive strength,
becomes a bottleneck.
Becomes a bottleneck and a huge cost driver because they just can't get enough good product out the door efficiently.
Precisely. It completely undermines their whole vertical integration advantage. It cripples their ability to meet customer demand profitably, and then you add the damage from losing that wafer market share.
Right, the cash cow drying up.
It just erodes that reliable income stream at the absolute worst time, especially when they're facing price pressure from competitors. And then you hear reports, mentioned in the sources, of losing key auto customers. That just adds more concern about whether they can actually turn potential deals, these design-ins, into real high-volume sales.
So what's the theoretical value proposition then? What do they tell customers they offer?
Well, the pitch, according to the sources, is all about delivering 6 and GaN solutions for better energy efficiency, sustainability, enabling systems that are smaller, lighter, faster, more powerful.
Usual semiconductor promises.
Pretty much. They claim their tech can lead to a better system cost structure for the customer. Maybe fewer components needed overall, a bill of materials, the be a BOM, maybe less maintenance down the line. Their tagline is unleashing the power of possibilities. They talk about values like safety, integrity, ingenuity, accountability.
Okay. Sounds great on a PowerPoint slide.
Yeah.
But the sources suggest a pretty big gap between that pitch and the reality right now.
A huge dissonance, yes. The financial mess, the operational problems. It creates a serious credibility gap. Think about it. If you're buying components for cars or industrial gear that needs to last years, maybe decades.
You need a reliable supplier.
Absolutely. Supply chain continuity is everything. So worries about Wolfspeed stability, whether they'll even be around, that could easily start to outweigh any perceived tech advantages for some customers.
And those internal cost problems, the low yields, the underutilization that directly challenges the better system cost claim they make to customers, doesn't it?
It completely undermines it. If their own costs are through the roof because of inefficiency, they have two bad options. Either charge uncompetitively high prices to cover those costs, or absorb the hit themselves and destroy their already terrible margins.
Right. Lose-lose.
Pretty much.
Yeah.
So, okay, let's try to summarize this first part based purely on the sources provided. What does Wolfspeed do? How does it make money?
They're a pure-play SiC-GaN company, vertically integrated from making the raw material crystals to the finished devices. They sell mainly into EV, energy, industrial, and communications markets. Money comes from materials and power devices, mostly, with a bit from licensing and services.
Good summary. And crucially, based on these sources, is the company currently profitable with a strong balance sheet?
That's an easy one. No. An unequivocal no. The sources show they're deeply, deeply unprofitable, negative gross margins, negative operating margins, negative net margins.
Margins are bad.
All bad. And the balance sheet. It's under severe stress. You've got excessive debt compared to equity. Huge negative free cash flow, meaning they're burning cash like crazy. And they've formally issued that going concern warning.
Which, just to remind everyone, means their own auditors have expressed substantial doubt about their ability to continue operating for the next 12 months. It's a serious red flag.
A very serious red flag. And you mentioned metrics like the Altman Z-score predicting bankruptcy risk.
Yeah, the sources indicate a score well into the distress zone, high probability of bankruptcy based on that metric.
Okay. So we've looked pretty closely at the business itself, the tech, the strategy, the internal challenges, and this really precarious financial state.
Yeah, the view from the inside, so to speak.
Right. Now let's shift gears. Let's look at the external view. How does the market see Wolfspeed? And what are the broader risks and opportunities ahead?
Okay, shifting to market sentiment. And, well, after everything we've just discussed about the financials, you can probably guess how the market feels.
Yeah, I'm guessing. Not great.
Not great is an understatement. The sources describe market sentiment as overwhelmingly negative, deeply pessimistic, really.
We mentioned that catastrophic price drop over 94% in a year, and shares falling, what, 60, 70% in a single day just on reports of bankruptcy filing.
Exactly. Those bankruptcy fears are just completely dominating the narrative, and the company's own going concern warning just poured fuel on that fire, confirming how serious things are.
So analysts covering the stock, they must have reacted.
Oh, yeah. Downgrades across the board, drastic cuts to price targets. Some analysts, according to the sources, have even suspended coverage altogether. They're basically saying the probability of a major restructuring, maybe bankruptcy, is so high, it's almost impossible to model the company's future value right now.
Wow. When analysts just stop covering you.
It's a bad sign. And other market indicators back this up. High short interest, meaning lots of bets that the price will fall further. Options pricing suggests expectations of continued extreme volatility. Trading activity has been really high, very frantic, especially around any news related to bankruptcy.
It's just wild how fast sentiment can flip, isn't it? 1 minute, you're a tech leader, the future of energy.
The darling stock.
Right. The next, Once those financial and operational cracks become undeniable, the entire story shifts to survival risk. Is the company even going to make it?
It's a brutal reminder of how markets react to execution failures, especially when combined with financial distress. Now, one thing our listener asked about was the ownership structure. Who actually owns the stock?
Right. Institutions, insiders.
Unfortunately, the specific source material we were given for this particular deep dive doesn't really detail the current ownership structure of Wolfspeed. So, based purely on these sources, we can't really get into the specifics of who the major shareholders are right now.
Okay, fair enough. We stick to the sources provided. So let's move on to the bigger picture then, the risks and opportunities. Sometimes called a SWOT analysis: strengths, weaknesses, opportunities, threats. The sources kind of synthesize these points rather than listing them formally, so we'll discuss them as key takeaways from the material.
Sounds good. So, looking at the derived strengths from the source content, Wolfspeed definitely has a significant portfolio of intellectual property patents in CC and Janet. That's valuable. They were pioneers in 200mm CC manufacturing, giving them that early capability. They have that vertical integration model, controlling things from crystal growth to finished device, which could be a strength for quality and supply control, if executed well.
Big if right now.
Big if. Their U.S.-based manufacturing footprint aligns with current strategic priorities, onshoring critical tech. They clearly have deep technical expertise built over decades, and their products target these massive, undeniable growth markets, EVs, renewables, etc.
Okay, those are the theoretical strengths.
Yeah.
Now, the derived weaknesses, which seem pretty overwhelming based on our discussion.
They are significant, yes. First and foremost, the severe financial distress we've covered, the going concern, the huge debt load, the negative free cash flow. It's critical. Then, major operational inefficiencies. Those low yields at the 200mm fab are a killer, leading to underutilization and high costs. Deeply negative profit margins gross, operating net, all bad. They're eroding market share in that foundational CC materials business.
The cash cow is sick.
Exactly. The sources also mention an inability to efficiently convert potential deals, those design-ins, into actual revenue streams. There are reports of losing key customers like potentially Tesla and VW. The company's seen significant management churn and instability recently, and of course that heavy dependency on external uncertain government funding.
Okay, that's a heavy list of weaknesses. What about opportunities? Is there any light at the end of the tunnel, according to the sources?
Well, the sources definitely point to the market opportunity. The long-term growth forecasts for CC and GaN semiconductors globally are still very, very high.
The tide is rising, even if their boat is leaking.
Kind of, yeah. Demand drivers remain strong: EVs, energy efficiency, renewables, industrial automation. The industry is moving towards 200mm wafers, which is where Wolfspeed invested heavily and has that early capability if they can fix the execution.
Another big if.
Always. There's the potential upside from U.S. government support She Peaks is funding, those tax credits if they materialize and are deployed effectively. And maybe, long-term, customers looking to de-risk supply chains might favor U.S. suppliers like Wolfspeed, again, if they can stabilize and prove reliable. There's also mention of maybe developing a regional SiCe ecosystem around their big facilities like Siler City, but that's very long-term.
Okay. And finally, the derived threats.
Yeah.
What external factors could make things even worse?
The competitive landscape is brutal. That's a key threat highlighted in the sources. Intense global competition. You've got specialized players, big established semiconductor companies moving into SiC, and particularly aggressive, lower-cost Chinese SiC substrate manufacturers really putting pressure on pricing in the materials market.
Undercutting their old business.
Right. Plus, competitors are racing to develop their own 200mm SiC technology and capacity, eroding Wolfspeed's early lead. There's a real risk of market overcapacity down the line, leading to price wars, especially if demand growth slows down, like the recent EV market softness that seems to be impacting revenues already.
Makes sense.
Then there's the huge threat of simply not securing that anticipated government funding or facing delays or reductions. And critically, the inability to successfully restructure their massive debt obligations. That could be fatal.
Yeah, that sounds like a deal breaker.
It could be. Interestingly, the sources also imply that Wolfspeed's own instability becomes a threat. High switching costs normally keep customers locked in, but here, the risk of relying on an unstable supplier might actually push customers to switch despite the cost and hassle.
Wow, that's ironic.
Isn't it? And of course, the persistent threat that they just fail to fix those core operational problems, the yields, the costs. And overarching all of this is the clear and present danger of bankruptcy, which could potentially wipe out all shareholder value.
It's really striking looking at those SWOT points derived from the sources, how the same thing can be in multiple boxes. That 200 millimeter leadership, it's a technical strength, right? And an opportunity to capitalize on market trends.
What? Yeah.
But their terrible execution turns it into a major weakness right now because it's inefficient and costly.
Right.
And it's a threat because competitors are catching up and might execute better.
It really highlights how execution is the absolute linchpin. Potential is worthless if you can't deliver on it efficiently and financially sustainably.
So let's try and bring this all together. Conclusion time.
Okay. So based on all the sources provided for this deep dive, what we have with Wolfspeed is a company built on potentially leading-edge technology in an industry, Siki and GaN, that undeniably has a very bright long-term future. But the company itself is currently in, frankly, a dire state. This is due to severe financial and operational missteps, critically low manufacturing yields at their key new facility, a crushing burden of massive debt accumulated to build that capacity, and significant ongoing cash burn, all of which has led to that catastrophic collapse in its market value.
The central tension here that the sources really highlight, it's stark, isn't it? The promising future of the industry.
Does not automatically guarantee the survival, let alone the success, of every individual company playing in that industry.
Right. Being in a booming market isn't enough.
Not even close. Success demands more than just having good tech on paper. It demands near flawless operational execution, incredibly prudent financial management, and the strategic smarts to navigate a really intense, cutthroat, global competitive landscape. Wolfspeed's current situation is just a powerful, maybe painful illustration of what happens when those fundamental business elements fall apart, even when you started with exciting technology.
And this really brings it back to you, the listener, doesn't it? Why digging into these situations matters. It shows that even in the most exciting high-growth sectors everyone's talking about, you absolutely have to look past the shiny tech headlines.
Got to look under the hood.
You have to look at the fundamentals, the basic business blocking and tackling. Can they actually run their operations efficiently? Can they manage their money responsibly? That stuff is absolutely critical. Understanding these dynamics helps you see the full picture, not just the hype or the marketing spin.
It's a vital lesson for evaluating any company, really, in any sector.
And that brings us back to that final thought, the hook we teased right at the start. Based on everything we've seen laid out in these sources today, can even the most advanced technology, the most promising market opportunity, can it really overcome the crushing weight of massive debt and persistent, unresolved operational failures?
Well, the sources strongly suggest the answer for Wolfspeed is far from guaranteed. It's looking very uncertain. And it highlights the sobering point, the true cost of execution failure. It isn't just inefficiency or losing a bit of market share here and there.
It's potentially much bigger.
It's potentially the loss of everything. The value that was created, the jobs tied to the company, the future potential of the technology itself, the very existence of the company as we know it. Even when you were a pioneer holding assets that were supposed to be unique and valuable.
Wow. That's something pretty profound to chew on the next time you're looking at a company in a hot market. The true cost of just not getting it done right.
It truly is. Execution is everything.
And look, if you found this deep dive into Wolfspeed valuable, and you want analysis like this, but tailored specifically for the companies you care about, well, that's exactly what we offer at Stock Analytics AI.
Yeah, for just $4.99 a month, our members can suggest any ticker symbol, and we prioritize creating a deep dive on that company, whether it's for general analysis like this or maybe timed around their earnings announcement.
It's a great way to get this kind of detailed insight focused directly on your interests.
Definitely.
So head over to the Stock Analytics AI YouTube channel. Please like this video if you found it useful, and subscribe so you don't miss any of our future deep dives.
And as always, just the necessary reminder, this entire analysis was based purely on the source material provided to us for this specific deep dive. It is strictly for informational purposes only.
Absolutely. It is not investment advice. We did use AI tools to help process the source material and structure this outline, but all the content, the insights, the discussion points, those come directly from the text provided in those sources.
Our goal here is simply to provide an impartial look at the information presented in that material to help you understand the situation as described in those sources. No recommendations, just analysis of the info provided.
Thank you so much for joining us for this deep dive into Wolfspeed. We look forward to exploring another topic with you again soon.